Welcome back to the Neuro Finance Masterclass. Today's explainer is tackling a massive theme, the exit strategy, when to sell.
You know, we've spent weeks together building up this incredibly strong financial fortress, right? Finding those great companies, laying down the foundation. But here's the reality check. Even the most impenetrable fortress in the world still needs an exit gate. Because honestly, buying is easy. It's the fun part. You click a button, it's a new beginning. But true neurofitness, that is actually tested when you have to find the exit.
Here is our blueprint for today. 1. The selling paradox. 2. When the thesis dies. 3. Spotting valuation euphoria. 4. Calculating opportunity cost. And 5. The architect's action plan.
Section 1. The selling paradox. Let's talk about the immense mental friction we all feel when it's time to actually hit that sell button. It's incredibly hard, isn't it? Think about the amateur mindset for a second. It's entirely driven by emotion. When the market tanks, they sell out of pure terror, literally panic selling at the absolute bottom. But then, ironically, when the market is soaring, they're suddenly paralyzed by greed at the very top. Selling at a loss completely bruises the ego, and selling at a profit just triggers this insatiable greed. It's a massive lose-lose psychological trap. Now, look at our ultimate goal, the architect. The architect operates strictly on cold, hard facts. They remove ego from the equation completely. We're going to learn how to adopt that exact sophisticated, disciplined mindset today by looking at 3 totally factual, non-emotional reasons to sell. Reason 1. When the thesis dies.
Think back to our Day 45 explainer on analyzing balance sheets. When you buy a stock, you have a thesis, right? A rock-solid fundamental reason why you believe that specific business is going to win. But what happens when that story just totally breaks down? Maybe you bought in because they were the undisputed kings of innovation, but now they're clearly lagging behind everyone else. Or maybe their debt is just creeping up quarter after painful quarter. Listen, if the original reason you bought the stock is completely gone, your thesis is dead. Period.
Which brings us to the absolute golden rule for the architect. You never, ever rely on blind hope. Honestly, hope is an emotion, and it has absolutely zero place in your exit strategy. If the fundamental facts of the business have changed, you don't just sit on your hands hoping for some magical turnaround. You execute the exit immediately. You trade on facts, not feelings.
Reason 2. Spotting valuation euphoria.
You guys remember Day 43, right? When we dug into the PE ratio? Let's say you did everything exactly right. You did your homework, you bought a fantastic, reliable company at a completely rational PE ratio of 15. The math made total sense. But then, suddenly, maybe it catches fire on social media, or the market just goes on a wild speculative run. That exact same stock balloons up to a massive PE of 150. Now ask yourself, did that underlying business actually become 10 times more profitable overnight? Of course not. The market has just temporarily lost its mind.
When a stock hits that level of absolute extreme euphoria, you have to wake up and realize this is no longer an investment, it is a bubble. And this is exactly where the amateurs get stuck. They're terrified of missing out on, just a little bit more upside. But as an architect, selling when the price totally disconnects from the actual factual value of the business isn't missing out. It's mathematically capturing a definitive victory. You are literally taking chips off the table while the rest of the crowd is acting completely foolish.
Reason 3. Calculating opportunity cost. Think about your capital as a strictly limited resource because, well, it is. Imagine you're holding on to this mediocre stock. It's doing okay. It's not crashing and burning, but it's certainly not thriving. Your money is basically trapped there. Now imagine you've just uncovered this incredibly exceptional, magnificent company that's currently trading at a massive discount. Every single dollar you have tied up in that okay stock is a dollar you can't use to buy the exceptional one. The mathematically correct move? Liquidate the average position to fund the superior opportunity. We aren't out here collecting stocks like they're little trophies on a shelf. We relentlessly reallocate our capital to get the highest possible return based on the facts.
Section 5. Today's action plan.
So, I want to leave you with a highly practical cognitive task, something you can apply to your portfolio literally today to build that empowering discipline. Step 1. You need to review your holdings not as a sentimental owner, but as a cold-blooded auditor. Just totally drop the emotional attachment. Step 2. Ask yourself the core question, which we'll cover in just a second. And step 3, if the math dictates it, you execute that exit without a single moment of hesitation. And here is that ultimate provocative test for step 2. I want you to look at every single position in your portfolio today and ask yourself this exact question. If I didn't own this today, would I buy it at the current price? Think about that. If your answer is a hard no,
then literally the only reason you're still holding it is emotional attachment. Your ego is in the way. Maybe your thesis is dead, maybe the valuation is totally euphoric, or maybe the opportunity cost is just too high. But if the answer is no, it's time to act like an architect and execute your exit. So what's hiding in your portfolio right now that needs to go?